Welcome back again. This session we're going to talk about actually how to make those adjusting entries. And the first account that we're going to look at that needs adjustment is the supplies account. So what would happen, in this case we know Net Solutions had a supply balance of $2,000 on the unadjusted trial balance. Of course we know some of those supplies have been used, so what we would do is go do a physical inventory. And on December 31st, we went and did our inventory, and we estimated that we had $760 of our supplies still on hand. Well, if we had 2,000 and now we got 760, we subtract and find out that we used $1,240 worth of those supplies. So what we would do is we would make a journal entry, and the journal entry would look like this. We would debit the supplies expense for $1,240 and credit supplies for $1,240. And when we posted that to our ledger, we would see that would when we put a credit in for $1,240 to the supplies account, that drops the supplies account down to $760. And if we had already recorded, if we had a supplies expense account of $800 initially, when we added this $1,240, that would give us a supplies expense account of $2,040. And the reference 55 is to the supplies expense ledger number, and the number 14 showed on the journal is the account number for supplies. And then remember, in your ledger you would put a 5, because this is on page 5 of our journal as your post reference. Remember about those post references that we did last in chapter 2. Okay, the next expense we're going to look at is the prepaid insurance account. Remember, we bought the insurance on December the 1st, and we had paid $2,400 for a 12-month policy. And so we debited prepaid insurance for on December the 1st, $2,400, and credited our cash for $2,400. Well, on December the 31st, what we will have to do is make an adjusting entry, and that adjusting entry will look like this. On December the 31st, see in our date column we got 31. At the top of the page, remember, it would have the year and the month. But we debit the insurance expense for $200, 1/12 of the $2,400, and then we credit prepaid insurance for $200. The account number for the insurance expense is 56. That's what that post reference number 56 means. And the account number for prepaid insurance is 15, and that's what that post reference means. And then again, in your ledger for the prepaid, in your ledger for prepaid insurance and insurance expense, you would put a post reference of 5, assuming this is still on page 5 of our journal. And now we're going to take a look at another exercise. And this is exercise, example exercise 3-3 on page 107. And it says prepaid insurance account had a beginning balance of $6,400 and was debited $3,600 for premiums paid during the year. It says journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance related to future periods is $3,250. Okay, so if we add those two numbers together, we get $10,000 worth of insurance. If we still have $3,250 that is good in future periods, that means we use $6,750 worth of insurance in our current period. So we would debit insurance expense $6,750 and then credit our prepaid insurance for $6,750. And so that one's pretty straightforward. We started out with $6,400 in the prepaid expense, paid out another $3,600 for additional prepaid insurance, gave us $10,000. We know that we still have $3,250 that will be used in future periods, and we subtract that from the $6,400 and the $3,600 added together, and we get $6,750. The next thing we're going to look at is the unearned revenues, and we already talked about this one already. This is where Net Solutions took in $360 on December the 1st, and we put it in an unearned rent account. It was for the months of December, January, and February. So it's $120 a month. So our journal entry would look like this. We would debit unearned rent for $120, and then credit the rent expense, or rent revenue, I'm sorry, for $120. And again, we see our account numbers in the post reference column, and we see how we would post that to our rent revenue account. And for some reason they did this on 2 slides. I'm not sure for the reason for that. But we will take a look at another exercise now. This is practice exercise 3-4 on page 108. It says the balance of unearned fees account before the adjustment at the end of the year is $44,000, and this is from our unadjusted trial balance, $44,900. It says journalizing the adjusting entry required if the amount of unearned fees at the end of the year is $22,300. So we would subtract the $22,300 from the $44,900, and we come up with $22,600. We would debit the unearned fees for $22,600 and credit fees earned for $22,600. The next account we're going to look at is going to be an accrued revenue account. And remember, Net Solutions signed an agreement with Danker on December the 15th to provide services at a rate of $20 per hour. And as of December the 31st, Net Solutions have provided 25 hours of assistance. Now, this won't be billed out until January the 15th. But what we would need to do on December the 31st is we would need to debit our accounts receivable for $500 and then credit our fees earned for $500. And then you can see where we made the entry into our accounts receivable account, and then on this slide you can see where we moved it into our fees earned. And again, you have your post reference columns shown there. And now we're going to take a look at another exercise. And this is exercise example exercise 3-5 on page 109. And this one, it says at the end of the year, $13,680 of fees have been earned but not yet billed to clients. And so we want us to make this journal entry. We would debit our accounts receivable for $13,680 and then credit our fees earned for $13,680. And of course that is to accrue the fees that we've earned. The next example we're going to look at is going to be an accrued expense account. And this is for our wages. Remember, we said on December the 31st that Net Solutions still owed its employees $250 of wages. So we would need to make an adjusting entry for that, and it would look like this. We would debit our wage expense, $250, and credit wages payable for $250, and we would say to accrue wages to the end of the year. And you can see where that's posted in both accounts here. And this shows what would happen when we pay those wages on January the 10th of the following year. We would debit we're paying out $1,275, but remember we've already recorded $250 of that as wage expense. So we would debit it wage expense for the difference of $1,025. credit the wages pay or debit the wages payable for $250, and then credit our cash for $1,275. And we're going to stop at this point, and we'll pick back up with depreciation expense. Please look at it, practice exercise or example exercise 3-6 on page 111 and work through that one. And we'll pick back up on page 111. Thank you and have a great day.